The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
A modest reprieve for a jittery market as the bond yield tail continues to wag the dog. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Boston.
And I'm Alex Steele. It feels like it's Friday before Memorial Day weekend.
I thought
but
it was
it's
Friday
Thursday.
earlier today.
Oh, I'm sorry.
But yeah, my producer informed me.
That was not the case. There's yet another day of programming. All right, the S&P is up 0.4%, but the volume's really light. But it is a reversal from what we saw earlier, particularly in the futures market trading. And a big part of that had to do with Fed President Waller. He talked about the fact that maybe we would see a rate cut in July if tariffs went back below to 10%. That helped turn around the 2-year yield, which turned around stocks, turned around the dollar, and weighed a little bit heavy there on gold, Romaine.
Absolutely, and we want to start with the Treasury market. We had 7 straight 10-year TIPS auctions that drew higher than anticipated yields, but today that streak was broken. 2.22% that came in right at expectations, and that was a welcome reprieve after that surge we saw in long bonds earlier in the session. But just because yields are back in the pocket doesn't mean volatility has followed. The risk premium to hold longer dated treasuries, that's still up a percentage point versus a year ago and still rising.
It is an anti-duration trade. And what you're seeing in the back end curves globally is that they're behaving like risk assets, not like the typical kind of defensive risk-adverse assets. And that just kind of feeds upon itself, which is why you have 2 separate bond markets.
And housing market data this AM reflecting that as the spring selling season is turning out to be not much of a season at all. Contract closings on existing homes logging their weakest April since 2009, which follows the weakest March since 2009. But unlike 16 years ago, mortgage rates today sit at 6.92%, 2 percentage points above where they were back then. And that puts the focus back on Congress, where the budget bill that threatens to raise borrowing costs further squeaked past the House of Representatives last night, and now it's got to run through the Senate. And if you think the senators are going to be any more fiscally responsible, you thought wrong. Senate Finance Chair Mike Crapo telling reporters he plans to expand on the tax cuts, a pitch that would take the $4 trillion in lost revenue that the House passed overnight and boost that to $5.25 trillion if he has his way.
Uncertainty, deficits, recipe for that 30-year yield moving higher. I appreciate that we're a bit lower today, but I think the levels that we hit are quite important. So this is the 30-year. We obviously know the headline that it's the highest level since 2007, but we did wind up hitting 5.15. The cycle high for the 30-year is 5.17. So today, we almost hit it and breached it. Now we're back down a little bit from that level, but nonetheless, once you kind of breach that level, we're in a whole different kind of ball game here. And even Goldman Sachs says we're in the place where we're starting to see yields weigh and move on the equity market, Romaine.
Absolutely here. And of course, there's 2 sides to that coin. Of course, the rising yields certainly cause for concern, but also potentially an opportunity for some investors out there. Stephen Laipply joining us right now, global co-head of iShares fixed income ETFs over at BlackRock, kicking us off to the close. And Stephen, I do want to talk about those opportunities right now. 4% on the short end of the curve, 5% on the long end of the curve. Is this an attractive opportunity to buy and, more importantly, to buy and hold?
Hey, Romaine, thanks for having me. I mean, yeah, what's interesting, if you have to take a bit of a wider lens here, if you pull back, 10 years are right around where they were almost a year ago to date. So, you know, we've seen quite a volatile ride here. We went all the way down to 360. We're pushing back, you know, above 4.5. I think the important thing here is that for the first time in a very long time, and again, you do have to go back to the mid-2000s to see yields across the entire investable universe at these levels. You're able to get income in fixed income. And I think that's actually the important point. You are going to continue to see this volatility. There's no doubt. So what we've been advising our clients is just to focus on the long term, take a long range view of the bond market and lock in these yields, because this is attractive, and it's more attractive than it's been in quite some time.
Where are you seeing the most activity, particularly in your BlackRock products? Is it pretty much across the curve, or are people still weighted a little bit more heavily towards the shorter end?
Well, yeah, it's interesting. It's a bit of a change from last year. So most of the flows last year, what we've seen over, let's call it 2 to 3 years, a lot of the flows have been in treasuries, and that was weighted more towards the long end in the prior years. This year, it's mostly weighted towards the short end. So about half our flows this year so far are in treasuries, and about half of that is in the very short end of the curve. But when you move past that, you do see a decent balance of flows in what we call the belly of the curve. So call that kind of 3 to 7 years around there in both multi-sector and investment grade. High yield, by definition, is going to be in that area anyway. But it has been interesting in treasuries to see that rotation. People have gotten a little more cautious on the long end.
Stephen, do you think that we breach 5.17? Like, are we going to be in a new range now and a new cycle for the long end of the bond market?
That's hard to say. I mean, as we've been talking about, and as the news cycle has been unfolding here with what's been going on with the tax and spending bills, you're right. Term premium has played a huge role in this. Most of the move in yields has actually been term premium related. So if you look at break-even inflation, it's down actually from the peak, a couple months ago. So it's really about term premium, and what term premium is pricing in is this risk and the concern around the long-term fiscal situation. So depending on how this plays out, you could see term premium creep higher. I mean, do we shoot up substantially more than this? That seems a little bit of a reach, but I mean, you could see yields, especially in the long end, continue to tread and grind higher as these headlines unfold.
So Leon Cooperman told us yesterday he could see 6% on the 10-year. Feels far-fetched to you?
For the near term, it does. We've had quite a run, and it's been pretty fast. Again, if I step back and I look over the last 2 years, I mean, we have seen this volatility up and down, and we've cycled this way. So it wouldn't surprise me to see things, continue to push higher here. But that seems like a bit of a reach for the moment.
When you look at the fiscal situation, though, and the idea that it continues to, I guess, get worse, I don't want to make this too slanted here, but let's just say our servicing costs will continue to grow and grow higher. And this gets to the term premium question here about being compensated for that added risk, and not just the risk of higher borrowing costs, but also and servicing costs, but also the risk, I guess, of political gamesmanship that maybe calls into question our willingness to make good on some of those debts.
And that's what the term premium movement has really been about. And what's interesting, when you saw the Moody's downgrade, the market actually had been pricing that in, appeared to be pricing it in several weeks before it happened. If you looked at sort of the levels on credit default swaps for government debt, it appeared that had been priced in. And then once the actual announcement came, not much happened after that. So I think we're at sort of a resting place for the moment. I do think we need to see how things unfold here and get a better view of what that long-term fiscal situation looks like. But for sure, could term premium expand? I think it could, depending on how the situation plays out over the coming weeks.
All right, Stephen, always great to catch up with you. Stephen Laipply is the global co-head of iShares Fixed Income ETFs over at BlackRock, kicking us off to the close here on this Thursday afternoon. Alex Steele. And when we come back, we're going to take a closer look at the state of the housing market and what to expect from tomorrow's new home sales numbers and building permits data after that disappointing existing home sales read that we got this morning. All that and more coming up in just a bit, right here on The Close on Bloomberg.
U.S. existing home sales seeing their worst April since 2009, dropping to the slowest pace in 7 months. Here's what you're blaming: elevated mortgage rates and high prices constraining that affordability. New home sales and building permit data out tomorrow. Want to bring in Danielle Hale, chief economist at Realtor.com. Danielle, with the 30-year and the 10-year moving higher, 30-year mortgage rates are sticky. Do housing prices need to come down at this point, and by how much?
Yeah, I think when you look at the market, we've seen very slow sales pace, as you highlighted. The challenge is particularly acute on the existing side. New home sales have fared a little bit better, but not much. I think, we see that builders have been able to buy mortgage rates down for some of their clients, and that has made a difference for some builders. We just had some research out that shows that buyers of new homes have seen a 0.5 point lower mortgage rate over the last year. So getting down into that 6% range really seems to make a big difference for a lot of buyers in the market today. If we don't see mortgage rates adjust, as you mentioned, we're seeing them move in the opposite direction. I think we are going to need to see home prices soften a bit. And only time is going to tell exactly how much. It's probably going to vary throughout the country already. We're seeing some different price performances when we take a look at the different regions across the country.
I mean, I heard 30% today from our Bloomberg Intelligence analyst, that 30% home drop for prices. Is that realistic, you think?
That certainly would probably bring home prices and the cost of a mortgage back in line with long-run affordability numbers. But given the lack of building that we've seen over the last decade, I don't think that's a realistic decline number that we're likely to see. You look at today's homeowners, and in aggregate, they're looking at close to record levels of home equity. Most homeowners are in a very good position, and they don't necessarily have to sell. And so if home prices were to fall, that might cause inventory to seize up even more.
Is there any sort of real significant difference, Danielle, in what you're seeing between the existing home market, used homes, as we would call them back in the day, and new home sales?
Yeah, so what we've seen over the last year or so is that when mortgage rates move up, so mortgage rates have kind of waffled in the 6 to 7% range over the last year or so. And when mortgage rates are closer to that 7% mark, new homes tend to outperform. And as mortgage rates move back towards the low 6% range, we see existing home sales pick up a little bit. So we see existing home sales pick up, I think, because we have more home owners get into the market and decide to sell. It makes more sense for them because they're often turning around and buying a home. So they experience the market both as a seller and often as a buyer. And so we see inventory pick up a little bit, and then we also see that buyer demand pick up. When mortgage rates move higher, I think that's when builders and their ability to offer incentives like mortgage rate buydowns really have an edge in the housing market. So we are seeing different trends in the new and existing market. Some of that is, like I said, these competitive advantages that builders have and can offer. Another piece of that is probably also the regional trends. We see a lot more building in the South and also the Mountain West. And so that also affects the different regional performance that we see.
And as far as those building trends, we're going to get the building permits data as well tomorrow. So, I know the narrative is always that that's such a long-term measure. The idea that builders aren't really thinking about what's happening now or even what's happening next year. It's more about what the market looks like in 5-10 years. Is that an accurate way to think about it?
Yeah, I think building permits on the single family side of the ledger is probably 2 years or so down the road because that's their way of planning for the future and making sure that they're taking out the permits that they need to move now. It takes much less time to build a single family home than it does multifamily home. And so the lead time on a single family permit is shorter than on a multifamily permit, which takes longer to construct. But I think your point is right that permits give an idea of the general sense of the market, and then starts tell us a little bit more about how builders are reacting to what they're seeing on the ground right now. And builders have had a lot of challenges to deal with, not just the lack of affordability for home buyers challenging their margins, but also the broader policy environment has been pretty tough over the last few months.
And also, hasn't inventory been getting a little bit better? So you have inventory getting a little bit better, rates are still really high, and builders still have to give concessions.
Yeah, inventory has been improving. I think it highlights how low we were. So today's existing home sales data showed that month supply, we're at a 4.4 month supply, which is the highest that it's been in some time. But economists typically think of 4 to 6 months as a balanced market. If we look at the annual figures, the last time we were in this balanced market territory was all the way back in 2016. So it feels like a very different market than we have been in most of the rest of the last decade. But it's really just the housing market getting back to a place of balance that it hasn't been in for the better part of almost 10 years.
Right. And then you add on the rates issue and the affordability issue, and it's really hard to see how that balance right sizes itself. What about the older population in terms of being sticky and staying in their homes as well? What is that doing to the market?
Well, they're a significant contributor to the fact that we do have home equity at record high levels. So older households are more likely to own their homes outright, or if they do have a mortgage balance, it's more likely to be a smaller mortgage balance. So that makes them a little bit less sensitive to mortgage rates, and they were an important part of the home buying universe over the last couple of years. But now some of that has played out. They are still enjoying those equity benefits, but then they are also experiencing the homeownership cost side of the ledger with rising property taxes and rising insurance costs. And what that is likely to evolve over time. We are likely to see those households age out or choose to downsize, but in many cases, they're not downsizing in this market because it's hard to actually downsize and find yourself in a smaller footprint home that actually is a better move financially. So the cost might be similar. And so a lot of them are choosing to stay put. But as far as how that evolves over the long run, I do expect we're going to see those boomers kind of become a smaller share of homeowners in the market. But it's probably not going to be something that happens quickly. That's going to be more of a gradual process, is my expectation.
Yeah, the boomers know how to linger. Danielle, great stuff.
Ooh,
Danielle Hale, chief economist. Yeah, shots fired. Danielle Hale, chief economist over at Realtor.com. When we come back, we're going to take a closer look at the clean energy sector. House bill working its way through Congress right now would strip away several key incentives for solar power companies. We're going to talk to John Berger. He was the founder of a company called Sunnova Energy, and up until a couple of months ago was the CEO. We're going to get his thoughts here on where the industry is going and whether maybe they end up following the lead of Sunnova. That's coming up next here on The Close on Bloomberg.
We look forward to the Senate's timely consideration of this once-in-a-generation legislation. We stand ready to continue our work together to deliver on the one big, beautiful bill, as President Trump named it himself. We're going to send that to his desk. We're going to get it there by Independence Day on July 4th, and we are going to celebrate a new golden age in America.
As House Speaker Mike Johnson touting the passage of President Trump's big, beautiful bill in the House, one sector that may not share that sentiment is the solar sector. Those stocks down on the day after the new version of the bill accelerates the end of incentives for clean energy production and demand, by the way. Among those names is Sunnova, a company that sells rooftop solar panel systems. Their former CEO and founder joins us now, John Berger, former Sunnova Energy CEO and power industry expert. Hey, John, great to see you. Thank you so much for joining. It's been a long time. Two parts to this bill.
Thanks for having me, Alec.
One was demand and one was the supply, basically. Let's start with demand. Does this crush solar demand if you take away that 30% tax credit for residential solar?
Well, yes, in a word, but it does more than that, unfortunately. It is patently un-American to take a tax credit away from a homeowner and taxpayer and give it to monopolies, which are the utilities. So with this bill, with the new revisions that happened late last night, you as a homeowner will not get the same tax credit, even though you pay a lot of taxes, as a monopoly. A utility will get the benefit of that tax credit. That is patently unfair and un-American.
But to be fair, if I put solar panels in today, I still get that 30% tax credit. It's just the phase out of that 4% isn't there.
No, this bill, these changes as written, will allow that phase out to happen with monopolies, but not you as the individual homeowner and taxpayer. You will have to get your tax credit, even as phased out, through the monopoly or the utility. That is unfair. It doesn't make any sense, and it needs to change. If we want to talk about American energy independence, the first place to start is you should have the independence to do with your own home what you want to do, and you shouldn't be disenfranchised by having tax credits, your taxpayer dollars going to monopolies instead of going back into your pocket.
So, I mean, is there a way, though, for certain homeowners to maybe circumvent that? I know they're not going to get the tax credit directly, but it's a good point when you talk about this idea of sort of why a lot of people gravitated to some of these solar panels in the first place. It was a way to provide some separation between the traditional utilities or utility grid, if you will. What options are going to be left for those homeowners?
Nothing. Zero. They're given nothing.
What option?
When this phase out occurs, they will have no option, as opposed to utilities who will still be able to have for at least a few years the option to have solar tax credits and storage, by the way. And so solar and storage is really taking hold in the residential marketplace because consumers are looking for lower bills and higher reliability. They will have that option eliminated, and the tax credit will then go to the utility for the prescribed period of time, but not to the American homeowner and taxpayer. It's really a bad policy.
Why do we end up with this policy, John? And I don't ask that to be flip, but I am curious about the lobbying efforts in Washington and what presence your industry had down there when this was being considered and effectively being written into this bill.
Well, I think it's pretty clear, follow the money. And if the utilities are benefiting from this, then who do you think put forth this idea that's a terrible idea? Probably the utilities. Now, I don't know that for a fact, but I think that just goes with common sense. And so what we need to do, if we just looked at this and said, however you want to phase out the tax credit, the solar and storage investment tax credit, however you want to do that, make it fair, level the playing field, because we're already at an unlevel playing field with monopolies that the utilities. Make it fair. Whatever happens to utilities happens to the American homeowner and taxpayer, period.
I mean, John,
this is not a difficult concept.
From what I understand, though, it's not that the credits transfer directly to the utilities, but that the commercial solar panels still get the tax credit, whereas residential solar panels do not. That doesn't feel like it's just, moving it to utilities, though. What am I getting wrong here?
Well, because that would mean what the language change was, first of all, in the first draft, you as a homeowner, you could write a check or get a loan, and you can today be able to get that tax credit, correct? And so that was eliminated in the first draft. In the second draft, what they did was take away even the ability for a commercial company like Sunnova, like Sunrun, to offer solar panels and batteries on your home under a lease or power purchase agreement structure. They took that away too. So the utilities, either directly through construction of solar farms and hopefully batteries, and wind farms, or indirectly as they buy the projects or buy the power from the projects, are the ones benefiting from the American taxpayer dollars.
I see. Okay.
Not the direct taxpayer, the direct homeowner. That was the change last night. That is why the stocks are down so much with regards to residential solar.
So, John, do those companies go out of business? I mean, we know that Sunnova was already struggling, right? I mean, through high rates, weak demand, high debt, all the stuff. Do these companies now legit go out of business?
Yes. If you tilted the level playing field, which it wasn't level to begin with, right? We need to have consumer choice. Instead of just Houston, Dallas, and Texas, we need to have it spread everywhere. We have new technologies with solar and batteries and load management, electric vehicles. We need to break up the monopolies and allow this consumer choice to happen, just like you could do in continental Europe, United Kingdom, Japan, and Australia. We need to catch up. We need to update the regulations. They didn't do that. They even went further than that and untilted the playing field even further and gave a tax credit, taxpayer money, American taxpayer money, to utilities directly or indirectly, and then disenfranchised homeowners. Will the residential companies, solar companies, and storage companies, will they go out of business? Most likely so, yes.
Hey, John, we got to leave it there.
If this were to pass.
We got to leave it there, but it was really good to catch up. Let's keep talking about this as the bill continues to change, maybe in the Senate as well. John Berger, former Sunnova Energy CEO, Citi echoes that, saying that it changes the growth outlook for the entire sector. And what that growth outlook means, TBD. Michelle Meyer, chief economist at Mastercard, joins us next. This is The Close on Bloomberg.
3:30 p.m. here in New York. This is the countdown to the close. I'm Romaine Bostick.
And I'm Alex Steele. Definitely taking a look at the markets. Trading a little bit higher here, but volume's still really light.
Yeah.
It feels like a holiday Friday.
Yeah, we are headed into a three-day holiday week, and the holiday on Monday. So the markets are open tomorrow, but as you point out, the volume light. But look, it is a big turnaround, right? Were you making fun of me?
No, I was saying open. Like they're open tomorrow, but there'll be like 4 people
okay,
here.
All right. But I mean, but you came into this morning and there was a lot of concern. Yields were rising, stocks were falling, and that kind of got washed away pretty quickly. And I know this isn't necessarily going to be representative given how light the volume is, but it's raising a lot of questions here about whether the worst has been priced in and whether the best has already been priced in, and whether we just end up in kind of a range-bound market.
Is this just like a Goldilocks thing or something along those lines? Jamie Dimon did not think we were in the sweet spot. He made that really clear. Talk about the sweet spot. Not necessarily for retailers.
Not really. We got several retail reports already. We get a few more later tonight. We heard from Ralph Lauren. I like their suits. Good company here, but they're saying that they expect growth to slow later this year, primarily because of a lot of concerns about economic conditions and consumer sentiment.
Flip side, though, Urban Outfitters crushed it.
Yeah.
Anthropologie is awesome. Good candles. Really expensive, though.
Okay. I haven't been in anthropology lately.
Really?
No.
No, it's great. They have really quirky, cool stuff. But point being is, like, certain companies still do really well, but then the luxury guys really struggling.
Yeah, it's kind of a mixed bag in the retail space. Also a little bit of a mixed bag as well when it comes to other types of discretionary spending, including travel. Let's break it all down for you with Michelle Meyer. She's the chief economist of the Mastercard Economics Institute. Hey, Michelle. We want to start off on the retail side, specifically because, I mean, we've gotten a lot of these earnings already. And I mean, most of the retailers have kind of said the same thing, though we're seeing differences in their earnings results. And it's getting to this idea as to what is consumer demand looking like right now, particularly for discretionary items, and how well, if at all, do you think that could hold up as we get deeper into the year?
Well, I think the conversation you were just having was a real clear description of what we're seeing and hearing from the retailers, which is that generally are still seeing the consumer that's engaged, that's spending, some more for certain brands and names than others, which is business as usual in terms of consumers choosing how they're prioritizing their purchasing power based off of what the demand is at the moment. But where I think it's really interesting is the guidance of what retailers are saying about what's to come. And that's where this uncertainty, I think, is playing a role. It's a really hard time to be forecasting because the headlines have been moving quickly. The good news is that things have settled down a bit in the last few weeks, and that's clearly evident in the markets as well, as you all were talking about as well, in the sense of markets ending up maybe in light volume, but still up, which has been the theme of the last week and a half, as some of the risk factors are now being priced out. And increasingly, we'll see how that plays out in the hard data as well.
Well, that's what I'm curious about. If we are seeing a bit of a retrenchment, is it all based on sentiment? Because, I mean, I look at prices right now. They aren't materially higher than where they were, 4 months ago. It seems like if the things you wanted to buy today or 3 months ago, you're pretty much going to pay similar amounts of money. So what's holding people back?
Well, that's exactly right, Rami. I mean, in reality, not much has changed in terms of what would influence the quote unquote hard data or actual consumer spending and behavior. It's more about sentiment and headlines and fear about the unknown and what's to come. So when you think about the CPI report that we just saw for the month of April, overall CPI actually moderated. Now, part of that was discretionary services pricing easing. But even on the good side, there wasn't clear evidence that tariffs was playing a role yet. And I think in terms of the supply of goods, consumers still at the moment can really still get the product that they demand. The distortions haven't yet shown up, it seems, in terms of what's actually there on the shelves, partly because a lot of companies were proactive. If you look at the import data for Q1, there was a significant increase in imports, a significant increase in inventories as well, as some companies tried to stockpile ahead of this period of uncertainty related to tariffs.
Yeah, that's why it's so confusing, because you get the sentiment, you get the data, and then you get what companies say, and they all don't necessarily match up. Just look at Urban versus Ralph Lauren, right? Two totally different descriptions. What have you guys noticed, say, in terms of how consumers are spending, like on travel, for instance?
Sure. So when you look at overall spending based off of our own insights and data, we are seeing consumers spend at a fairly trend-like basis overall on aggregate. We haven't seen significant shifts that would be indicative of sentiment creating real measured differences in terms of spending. But I'm glad you brought up travel, because we just released our annual travel report from the Economics Institute, where we look at not only what bookings data are showing today around where consumers are going to choose to travel into the summer, which is about to kick off with Memorial Day weekend right in front of us, but also talks a lot about the why consumers are choosing to travel and what are going to be the drivers as we look ahead. So to us, as we think about an environment where there's more uncertainty, there's maybe more caution in terms of how consumers are making their decisions, they're going to be really mindful around where they choose to travel. So thinking about traveling for wellness has been a big theme that has really picked up speed. Traveling for adventure, a lot of foodies, sporting events, overall concerts. You're seeing a real wave in terms of cross-border spending for those activities.
And is that all like with cash? Is it, well, no, because you're MasterCard. But like, how much of that is going on, say, rolling credit debt?
Well, look, I think there's many different forms of payment. For when you tend to have a bigger ticket purchase, like a trip, oftentimes it's not necessarily an area where people are going to be able to use cash. So yes, we're looking at the overall trends in terms of spending.
All right, so Larry, let's get to the fun stuff. Michelle, where exactly are people going here? I mean, I've taken a couple trips already this year, my family as well, overseas. Is there like a hot spot now that you're starting to see bubble up?
Yes, when we look at bookings data, the list is.
Go ahead.
Am I back?
Yep, you're back. Go ahead.
Okay. Top of the list is Tokyo. That's followed by Osaka in terms of the two top markets for travelers coming from throughout the world. When you look at the U.S., where travelers are going, Tokyo still ranks as the number one, but you also have San Juan that's high up on the list, Maui that's up on the list. I personally, my family, I just visited Hawaii during last December break, and it was fabulous. So you are seeing consumers and that are going out and traveling for a variety of reasons, whether it's to see these cultural sites, to experience wellness. It could be where the currency really works very well, which is one of the factors that seem to be driving this increase in travelers to Japan in particular.
Yeah, I mean, I feel like that's become a trend here. I also saw you had listed in this report, Albania has apparently become popular, at least among certain European tourists.
Yes, and that was a trend that we started to sniff out last year in our travel report. It was one of our key takeaways was Albania was going to be the new kind of big coastal retreat when visiting Europe because of the value play, and it looks like that has continued to build momentum. And part of that comes this idea of travel twins, where people want to go out and travel, they want to have those experiences, but they're going to look for value in doing that, and they're going to look for the way they can make their purchasing power work the best.
All right, Michelle Meyer, Chief Economist of the Mastercard Economics Institute. A lot of great travel ideas. Albania. Are you an Action Bronson fan?
No.
Oh, okay. He's Albanian.
Oh, okay.
That's the only Albanian,
Is this pop
famous
culture
Albanian that I know.
I have to know?
It's pop culture, Alex.
No, I'm not going to know that.
It's music, though.
Definitely not, then. Okay.
All right.
Super nerd, musical theater nerd.
Okay, all right. Did you watch the basketball game last night?
Yes. No.
Okay. We'll have more questions for Alex Steele during the commercial break, but when we come back here, we're actually going to take a look at the new kid on the block in terms of public markets.
I see what you did there.
Thank you. Mountain actually going public here. This is the ad tech firm, of course, most famously affiliated with Ryan Reynolds, debuting on the NYSE today. You see the pop in the stock on day one. It's our stock of the hour, and that's coming up next right here on The Close on Bloomberg. All right, if you watch this program, you're familiar with Mark Douglas. He founded a company called Mountain that basically helps small and mid-sized businesses advertise on the streaming platforms. He founded that company just a few years ago, and today it went public. He sold shares at $16. It opened on the NYSE today at 21 and trading right now at 25. Katie Roof of Bloomberg News joins us from our West Coast Bureau to talk a little bit more about the new kid on the block. And Katie, we haven't had many IPOs, and certainly not many IPOs of this sexiness, if you will, because Ryan Reynolds is the chief creative officer. Tell us about it.
Sure, always happy to talk about Ryan Reynolds. But yeah, there haven't been many tech IPOs in the last few years. Actually, Mountain had been trying to IPO for 3 years now, sources tell me. And so, the window hasn't been open, so to speak, but Mountain has been one of the few to test it. And so far, it's going well.
Is the window now open for IPOs, or do we feel that this was an exception?
Well, eToro went well, Mountain went well, Hinge Health also debuted today, pricing at the top of the range. So the most recent indicators have been positive in terms of new demand for new tech listings. So there are many tech IPOs potentially in the pipeline, and they're watching these to see if it makes sense for them to go in the coming months.
Well, Mark Douglas was on Bloomberg Television earlier today. He said that basically it was about 14 times the available shares out there was the demand, in his words. We'll go and verify that. But even if it was anywhere close to that, that would be a big shift from what we had seen in some of those IPOs that kind of straggled out the door at the tail end of last year and right at the beginning of this year.
Sure, yeah. So a lot of the tech IPOs of this year and last year have gone okay, but people are still scarred from, the cratering of the 2021 tech listings, and so many of those tech stocks did terrible in the subsequent months or years. And so even though there has been several listings that have gone well, there's still a lot of fear, a lot of anxiety in Silicon Valley, and a lot of people saying, well, why should I take my company public if the market's going to punish us? But maybe that's no longer the case.
So what's the line of VCs waiting to cash out here?
So they have some more well-known names like Greycroft and Qualcomm Ventures. They also have some LA-focused firms because that's where this company was originally headquartered. So you have Bonfire Ventures, which is known in the LA ecosystem. They're another one that wants to cash out here.
All right, Katie, thanks a lot. Katie Roof of Bloomberg News. We appreciate that. And to be fair, it's a day where there's no big news, there's no macro news, It's light volume, you're headed into a long weekend. I just feel like this was a good setup for the market.
Yeah, I mean, whoever was helping managing this deal, I don't know if this was planned or if they just got lucky. But, again, it gets to this idea, though, of what the appetite is for this stuff. And there was a lot of concern, over the last few months as to whether this was just going to kind of be a locked up market for quite some time. And at least it shows that something can get out there and something can be embraced.
It does, and I feel like it's the same thing for M&A. I feel like we're starting to see more a trickle of deals in a more consistent way, and I wonder if the IPO market is going to kind of do the same, and we're in a different kind of spot. Yeah, and particularly when you look at the types of businesses. You mentioned eToro. Obviously, this is something that maybe is a little bit more recession-proof. Similar story with ad tech, particularly with what Mountain does and their affiliation with Netflix and those streaming platforms, something that a lot of viewers view as being somewhat recession or economically resilient. All right, well, we are 15 minutes from the closing bell on this Thursday. You're looking at NASDAQ up about 0.6%, the S&P up 0.2%. We're a little less than half a point away from being positive now for the year. Heather Brilliant will be joining us to the close. This is Bloomberg.
You are going to continue to see this volatility. There's no doubt. So what we've been advising our clients is just to focus on the long term, take a long range view of the bond market and lock in these yields because this is attractive and it's more attractive than it's been in quite some time.
The volatility remains high, even if the volume is down. Stephen Laipply kicking us off to the close from BlackRock just about 50 minutes ago, Alex. And we should point out the price action, at least for right now, certainly favorable, at least if you are an equity bull. And as long as you're not in solar or utility stocks, because those are not doing well. You take a look at the alternative clean energy ETF down 1.2%, but really utility is getting hammered in part because of the bill and the clean tech within the bill. They're down over 2%, so it's not a great day for that sector. Yeah, certainly not here. And just a reminder here of just how much Washington really is wagging the dog when it comes to financial markets, whether it is on the budget bill, that solar bill, the crypto bill, and everything in between. Joining us right now to count us down to those closing bells, just about 9 minutes away, Heather Brilliant joins us here in Studio 2, the Chief Executive Officer at Diamond Hill. Heather, great to see you.
Thanks for having me.
When we talk about these moves that we've seen in yields, and pretty much almost, at least in recent days, almost lockstep moves, counter moves that we're seeing in equity prices, what is that telling you right now about how investors are viewing the market when we see those types of correlations, those inverse correlations at play?
I think, first of all, there's just such a tremendous amount of uncertainty. And so that comes through in the markets in various ways, of course. But overall, I think the weakness in the consumer, potential increases in unemployment, and the economic uncertainty that really comes from short term, are we going to be in a recession based on how the data comes out? And longer term, more secular concerns around whether we are going to be in a period of less global trade and how is manufacturing going to come onshore more, and things that I think are really, really long term and are still yet to be determined. It's kind of interesting, though. This week we got reports from several retailers, including Target, Ralph Lauren, and a few others, and it was pretty clear. They're concerned about the health of the consumer. They're seeing maybe a bit of a pullback, not a wholesale pullback. If you're an investor right now and you're looking to either reallocate or enter new positions, do you just completely avoid anything that says consumer discretionary? Do you look at consumer staples or healthcare, something that has defensiveness in nature? How do you approach this market given what we know right now? I think one way you can approach it is looking at the securitized bond market, where you can find opportunities to have some exposure to the consumer, but that might be a little bit more protected through the structures of the bonds. And also, I think in that market where you're seeing some of the variability of rates, we're seeing rates adjust, or I should say spreads adjust, to take into consideration those risks. And so on the equity side, I think it's better to look for opportunities for long-term consumer plays, but in the short term, I think there could be a lot more weakness.
So what do you like right now? Is it sector or is it straight up stock picking?
We're always about straight up stock picking, so just
in sectors
fundamentally. Yeah, I mean, I'd say, one of the themes I was thinking about when looking at the ideas that I'm bringing for today is really thinking about companies with really strong competitive advantages that are just getting sold off with other parts of the market. And so, especially when you're looking for companies with great natural resources that have long-term pricing power, I think you come across companies that are more well-known, like Waste Management, or companies that are lesser known, like U.S. Lime & Minerals, which has...
U.S. Lime & Minerals. Okay, explain.
I knew you were going to stick on that one, Romaine. So U.S. Lime & Minerals is approximately $3 billion market cap, so it's definitely on the smaller side, but it has access to resources in Texas in particular that it can produce limestone from. That essentially has two competitive advantages. One is the access to big construction markets and infrastructure that's going on, investments that are being made in Texas. And the other is really that there's a lot of regulation around that part of the market that they have really sorted out. And the third thing I'd point out really that I think is really interesting is that they're a very efficient operator. So they're very focused on returning capital to shareholders, making sure they are conservative with how they invest and the balance sheet they run. And there's very meaningful insider ownership, so great alignment between the management and the shareholders.
So active stock picking like that seemed to make a lot of sense when the S&P was in free fall and there was super big macro risk, right? But then all of a sudden we get the 90-day reprieve and things turn around and now we're almost positive for the S&P on the year. How does that thesis work in that environment?
I still think it works because we're looking at much longer term timeframes. And so when things like the sell-off in early April happened, that was a great opportunity. And we were adding to positions like some tech names that I think really got sold off with everything else. And now with everything, especially in large cap, getting closer to fully valued again, we're much more interested in looking in that smaller mid cap space.
Speaking in that space, and there's also been a big play over the last few months to find opportunities outside the U.S. The idea, if it's not a wholesale reallocation away from the U.S., certainly the idea of being a little bit more diversified. One of your picks is also in that same kind of environmental resource waste management space, but it's a French company, right?
Yes, Veolia Environment. Yes.
Veolia Environment.
Yeah, so Veolia is interesting because they have been very focused on execution as well. Their business is about a quarter exposed to water and wastewater treatment and things like that, and then a third is more geared towards waste management, more similar to waste management in the U.S., and then a third is more on the energy side.
Yeah.
And so that really gives it the opportunity, I think, to play in markets that are not very economically sensitive. So regardless of the economic environment they find themselves in, I think they can do really well. And then also, there's really not another global player in all those markets like Veolia. So they have competitors within each of their local markets, but on a more global scale, they really are one of a kind.
All right. Well, I wore my French tie for you just for that today. I am curious. I know you're a bottom-up stock picker, but I do just kind of ask you about broader macro issues, particularly given the tax cut bill going through Congress and a lot of concerns about government borrowing costs and what that feed-through might be on the financial markets. And I am curious if you do have any worries, at least worries to the extent that would cause you to maybe rethink some of your investment decisions or just maybe sort of reshape some of those investment decisions as a result.
Sure. I mean, I think everybody should really be taking a hard look at what is the future path of interest rates, what do we think is going to happen in the broader economy. And we generally think interest rates are going to stay higher. And so that reverberates through both on the equity side as well as the fixed income side, because on the equity side, you have to build that into valuations. And so assuming that rates are staying higher, I'd say we are looking for companies that are either trading at a bigger discount or looking for opportunities when they do sell off to be able to invest in companies we think are really well positioned in the long term.
All right, Heather, always a great conversation. Great to have you here in Studio 2. Heather Brilliant is the Chief Executive Officer at Diamond Hill, counting us down to these closing bells. The closing bells now just about 2.5 minutes away. And Alex Steele, the rally that we had on our hands in U.S. equity markets fading a bit into the close. Actually pretty heavy selling pressure into the close right now. The S&P flipping into the red. The NASDAQ erasing all of its gains.
Yeah, and that was just in the last, 15 minutes of trading. We are now off 0.6% now for the year. We were so close to breaking neutral, but that's not gonna happen today. All
right, we're gonna say goodbye to Alex Steele, but stick around. We got a full breakdown of all of today's market action starting right now.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostick here with Scarlett Fu, taking you through to the closing bell with a global simulcast. And it starts right now. Carol Massar and Tim Stenovic in the radio booth as we welcome our audiences across all of our Bloomberg platforms, television, radio, our partnership here with YouTube. A relatively low volume day, Carol Massar.
Yeah.
We had a strong rally going, but we should point out some significant selling pressure here as we get towards those closing bells.
Yeah, we were just noting as we were coming over to you guys, right, seeing some selling here into the close. You look at the charts and it's really kind of a rollover, if you will. You look at the VIX, though, it's something that has been up more than a point, down more than a point. Right now we're down about half a point. So the VIX, too, having a very volatile day. I think the investors are just a little kind of worried about what comes next, maybe.
Yeah, you see it on the chart right there. In fact, the S&P 500 moving between gains and losses about half a dozen times today, really searching for direction until about 1:30. That's when it was solidly in the green just until the last couple of minutes. Don't know exactly what happened, but seeing some selling into the close.
It definitely feels like we're meandering a bit. And the fact that there hasn't been a whole lot of real hard economic data this week might contribute to that. I mean, we also had a week in which we had the 20-year bond auction really have an impact on sentiment yesterday. The 10-year TIPS auction was today. What does it say that when we're so keyed into every single bond auction? It means people are looking for any kind of indication of demand for the full faith and credit of the U.S.
When was the last time you paid attention to a 20-year bond auction?
I know, right?
And then even that TIPS auction, I'm glad you brought that up because I paid close attention to that, something I normally wouldn't. Luckily, that did come in on the nose, but definitely the jitters are still there. As we get the closing bells here in New York City, we do just want to reiterate here, the S&P 500 at one point was up about 0.6% on the day, but it looks like it's going to close out in the red. We should point out, day 4 of this week right now, and the S&P has opened in the red on all 4 of those days. Now, it did close in the green on Monday, but that was it. Tuesday, Wednesday, and now Thursday, the S&P 500 lower by only about less than 0.1%. The Dow Jones unchanged on the day. The NASDAQ, Scarlett, holding on to its gains, but only of about 0.3%. And the Russell 2000 lower by about less than 0.1%.
All right. I have some breaking earnings here. We've got it from Intuit, which is, of course, the maker of TurboTax. The software company reporting third quarter adjusted EPS of $1.65, handily beating the consensus estimate of under $11. It also has raised its full year guidance as well. Now looking for a full year revenue of $18.72 billion to $18.76 billion. Previously, it had anticipated only as much as $18.35 billion. It sees full year adjusted operating income of up to $7.56 billion. Previously, I should say the consensus estimate is $7.32 billion. So you're looking at a boost here in the outlook, which is always encouraging for investors. And we should note, by the way, that the third quarter is the biggest quarter of the year for Intuit because it wraps in April 15th, tax day, when people buy TurboTax.
Yes, indeed. It makes a lot of sense. Hey, some more earnings coming. Ross Stores just crossing the Bloomberg terminal. First quarter results, EPS $1.47. That's a penny better than what the street was expecting. Actually, 2 pennies better than what the street was expecting. It's a penny better than the year before. Sales coming in at $4.98 billion. That's up 2.6% year over year. Estimate on the street was a little bit below that, $496. Inventories, $2.67 billion. That's up 8.5% year over year. The estimate was for $2.56 billion. So maybe a little bit of an inventory build. We do have the company's CEO saying, despite the slower start to the spring selling season in February, our monthly sales performance improved sharply month after month for the balance of the quarter. So certainly a read on consumers right now. The stock, though, guys, it is unchanged in the aftermarket.
Autodesk out with their results, of course, enterprise software company with a big focus on architectural firms, adjusted EPS of $2.29 a share. That's higher than street estimates of about $2.15 a share. A beat on revenue as well. And here's your forecast. The company is saying that for 2026, the full year, its full fiscal year of 2026, it sees billings in the range of 7.16 to 7.31 billion, the low end of that range, above the average of street estimates. Adjusted EPS for the year, it says, will be in the range of $9.50 to $9.73 a share. The top end of that range is above the average of analyst estimates. The share is higher by about 1.8% right now.
I'm looking at what's going on with Workday in the after hours. This is the enterprise software company focused on HR and the like. Shares bouncing around, down by about 2.6% right now. The company did see first quarter adjusted earnings per share beat estimates. The company sees fiscal year subscription revenue maintaining at $8.8 billion, sees second quarter subscription revenue coming in at $2.16 billion. That matched estimates. The company does see fiscal year adjusted operating margin at 28.5%. Earlier, it saw 28%, so that's a beat there. Estimates were at 28.1%. The company still, as I mentioned, sees fiscal year subscription revenue coming in at $8.8 billion. Shares right now in the after hours bouncing around, but down about 2.6%.
Hey, guys, I want to go back to Ross Stores because we saw this stock down about now 5.4% here in the aftermarket. A little bit more commentary from the company saying, given the varying nature of tariff announcements, we are only providing an outlook for the second quarter at this time and are withdrawing our previously provided annual sales and earnings guidance. So when we think about tariffs and whether or not companies feel like they have visibility, certain for a retailer who gets so much merchandise overseas, we can certainly see that that's having an impact. And so you've got Ross Stores down almost 7% here in the aftermarket. All right, that one is down. Let me go to some of the gainers in the regular session. Palantir is on that list. At its highs today, up almost 5%. It was a top gainer in both the S&P 500 and the NASDAQ 100, finishing the day with a gain of about 1.3%. Dow Jones Barron's out reporting on the company, noting that the U.S. Defense Department, said late yesterday after the close that it had raised the contract ceiling for a program that Palantir provides. It's their Maven Smart Systems software licensees by $795 million. So basically they're saying, and analysts are noting, that Palantir stands to win from these deepening ties to the Defense Department. So this one's been on a tear this year. It's up about 65%. Advanced Auto Parts, way out performance today, up about 57%. The company reporting comp sales that fell less than expected in the first quarter, also saying that it's reaffirming their annual sales guidance, or annual guidance, based on performance to date. The guidance assuming current tariffs remain in place for the remainder of 2025. But really some outperformance there. And Urban Outfitter also up about 23%, so a big move to the upside. The company reported net sales for the first quarter that beat the average analyst estimates, and analysts noting the strength in its namesake UO brand and are positive about the retailer's margin expansion. Stock now up more than 30% year to date. Scarlett, over to you.
All right, we have Deckers reporting results. This is the company behind Uggs and Teva sandals. They're withdrawing their full year guidance, or I should say not providing full year guidance for fiscal year 2026 because of the macroeconomic uncertainty related to evolving global trade policy. So you see that stock down about 7% in after hours trading. As for the quarter that was, for the fourth quarter, they reported net sales of $1.02 billion, just slightly higher than what analysts were looking for, which was $1 billion. And the EPS for the fourth quarter was $1 a share. But once again, that's backwards looking. Deckers is not providing a guidance outlook for this full year, but it does say it's capable of returning value to shareholders. Talks about the $1.9 billion of cash on hand, sustainable cash flow generation, and the increased buyback program, which now totals $2.5 billion.
All right, more retail news coming from Decker. Shares down about 10% in the after hours. Other retailers moving today. Williams-Sonoma shares falling 4.5%. Shares were down as much as 12% earlier in the session. Wall Street questioned the company's reaffirming full year net revenue guidance given its significant first quarter beat. Once again, shares down by 4.5% today. Also, I'm looking at the Invesco solar ETF. Solar stocks did so poorly today that I had to look at the entire ETF. We saw a lot of names move lower in the double digits. As a whole, though, this ETF fell about 7.5%. It tracks the MAC Global Solar Energy Index. The biggest holdings include First Solar, Enphase Energy, and Sunrun. Stocks fell as U.S. House Republicans' new version of the tax and spending bill accelerates the end of incentives for clean energy production. Taking a look at what actually fell in there, Sunrun down 37%, Solar Edge Technologies down 25%, Enphase Energy down 19.6% today. And finally, for the sports fans out there, Manchester United down 8.6% today. It's after we got some news about, well, just how they did, Romaine.
Yeah, they didn't do well.
That's
Tim,
not good.
Which always seemed odd to me. You lose and, somehow your stock goes down. Let's go take a quick look at yield. And these numbers really don't tell the whole story. Right now, you're looking at a 30-year yield moving lower on the day by about 4 basis points. But all the action was early this morning here, where we saw yields spike about 6 basis points on the long end of the curve to 5.15 on that 30-year. And that is where most of the action was. I thought Greg Peters over at PGIM Fixed Income really put it well here. There's really two bond markets out there right now. You have all the crowding going on right now in the short end of the curve, and on the long end, it's anybody's guess, because right now the tail is wagging the dog out of Washington right now with those budget bills and what it may add potentially to the deficit.
Yep, we're all focused on Washington, no doubt about it. All right, that's a wrap. Our cross-platform coverage, radio, TV, YouTube, Bloomberg Originals. Alex is heading out. Scarlett and Romaine finishing up there on television. Tim and I coming back to Bloomberg Business Week Daily right here on radio. Guys, we will see you again, same time, same place tomorrow.
And our coverage continues. We're going to take a closer look at some of those retail earnings, a closer look at emerging markets, and a closer look at the Treasury market, including a look back in history to 1991 and a big scheme by a trader over at Salomon Brothers who tried to corner that market. All that and more coming up in a bit right here on The Close on Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Welcome back to The Close. I'm Scarlett Fu.
And I'm Romaine Bosick. Another wild day on Wall Street, and it all kind of ended just a little bit flat. Now, we should point out volume is relatively light. Remember, here in the United States, Monday is a holiday, so you have a lot of folks maybe trying to front run that. You have an S&P 500 unchanged on the day, but at one point, it was actually up about 0.6% and looked like it was going to stage a pretty strong rally. Heavy selling pressure heading into the close. No real catalyst for that. That just could be some folks wrapping things up for maybe what for them could be an extended long weekend. The Bloomberg Dollar Spot Index actually rising for the first time in 4 sessions. That's an interesting development. And of course, all the activity this morning was in the bond market. A 30-year yield, of course, that did top that 5.1 mark on the day, though then came back down and actually finishing the day lower, down by about 4 basis points. One of the big bright spots out there, though, Scarlett, remains the same bright spot that was yesterday, and that is Bitcoin at a record high.
Yeah, $111,000 right now, and that's giving a lift to some crypto-linked names like Coinbase, up 5% on the day. You're seeing that across some of the crypto space. I also wanted to point out the solar energy companies, Enphase and First Solar, both down quite a bit. Enphase losing almost 20%. The tax bill that just got narrowly passed in the House earlier this morning ends subsidies for green energy much earlier than planned, by years, in fact. So the bill now moves to the Senate. We'll see how it all goes. But for now, it speaks to bad news for those solar energy companies. Our top story this hour, though, is the bond market not sold on Trump's one big beautiful bill. U.S. Treasury yields, especially at the long end of the curve, have been steadily climbing through this month as investors' focus shift from the inflationary impact of tariffs to how his tax cuts will widen the budget deficit. And it all adds up to a lot more debt at a time when the full faith and credit of the U.S. government is no longer seen as the risk-free investment it once was. Romaine?
All right. Well, joining us right now here in Studio 2 is Kristina Campmany, Senior Portfolio Manager of Global Debt at Invesco. And Kristina, I do want to start with the current state that we're at right now in yields and whether you think it's appropriately pricing in whatever we're worried about in Washington.
The risk that we have.
Yeah.
Well, thank you so much for having me on. So look, I think it's important to take a step back and say, where are we and where have we been? Mm-hmm. So we're pushing the high yields that we've seen in the last number of years in bonds, but 10-year treasuries earlier this year were at 480, and we're not pushing that. So it's really been this steepening of the curve in the U.S. and also globally. And I don't think that it hasn't been a panic move, and we're trying to digest as the administration, as what we're getting from the administration is shifting to the tax bill and the big beautiful bill. What do these numbers mean? Is it fiscal? Are we actually getting a boost to spending to offset some of the drag to tariffs?
Mm-hmm. Yeah, and it's a good reminder, too, just for our viewers, that while that bill did pass the House, it still has to go through the Senate.
Of course.
They've actually recessed, so they're actually not coming back to June 2nd. So it could be a couple weeks before we actually see the results of this. But as you sort of, I guess, deal with your own clients and just deal with the overall market environment here, you know there's a lot of concern.
Yep.
It's not panic, but certainly concern about what this means and where risk assets are priced, and for that matter, where the least riskiest parts of the market, the Treasury market, should be priced.
Yeah. So when we look in the U.S. and bonds, kind of we touched 515, we came back a little bit. And I think all of these auction events in the U.S. and actually globally too, because like there's a lot of focus in Japan, those are all, they're just, I wouldn't even say stress points, but like nervous points that like the market is anxious about who is the next marginal buyer and how are we going to be taken down. So our preference really probably zoom back the last 6 months, if not a year, has been for a steeper curve, and we've preferred to own duration in the front end. That probably still holds true. Would I tell you that 30 years are super rich at 5%? No, I don't think so, but I think that the trend is still that we drift higher, right? We're talking about fiscal deficit numbers even before this bill, if it gets through, in the like mid 6.5% ranges, which are really numbers that are much more consistent with like recessionary spending kind of stimulus, which that's not where we're at.
Kristina, you mentioned the global move a couple of times. And of course, we're talking about Japan and Germany both seeing their yield curve steepen. What is behind that? What is the common thread that ties these different markets together? Because I would imagine that each are moving on their own idiosyncratic reasons, but there's a temptation in the market for people to link everything together.
Yeah. So I think there definitely are different factors driving each of them. In Germany, certainly earlier, kind of in the last few months, this shift to actually get defense spending and the potential for real spending and kind of fiscal, defense independence within Europe is a big driver of that story. And I think it's just a real shift versus the 10 years we look back of the market's assumption that Europe is unwilling to spend. So I think that's that story. Again, when we look at the globe, the one place that we actually think that there is potentially some value, and it's been messy, has been Japan, because the curve is so steep and you have over 200 basis points of steepness between 10s and 30s. Again, the auctions have not been well supported. And I think the question is, who is the next marginal buyer? Do you see a change of kind of some of the official money come in to support that? But I think like that is one place when we look globally that there does seem to be value out the curve.
You also mentioned auctions. What does it say that we're all so fixated on every bond auction these days?
Again, I think it speaks to the stress in the market and the uncertainty. And I think the theme of the year has been the one kind of certainty is uncertainty. And we don't know the policy objectives of the administration. And we're all sitting here trying to weave through like, what are we trying to get at? What is the end game?
All right, good stuff. I really appreciate your being here today. Kristina Campmany is Senior Portfolio Manager of Global Debt over at Invesco. Romain?
All right, thanks, Scarlett. We want to take this opportunity to take a look back in history 34 years ago today, and one of the weirdest scandals in the Treasury market. That all came to a head, felling top executives over at Salomon Brothers, bringing a $290 million fine against the firm, and it actually fundamentally changed the way that the government polices the market. Now, it began to unfold back in December of 1990. That was when the head of government bond trading at Salomon Brothers, his name was Paul Moser, he submitted basically phony bids in the names of unsuspecting clients as a way to exceed quotas on the amount of notes that primary dealers were allowed to purchase at Treasury. It's complicated, but basically the Treasury would auction off these bonds first to the dealer with the highest bid price, then they'd go down to the next highest bid and so forth until all the bonds that it had available were sold. Now, when it gets to the lowest bids, the Treasury parcels out the remainder in proportion to the size of that final bid. Now, this is where Moser comes in. If Salomon could get its hands on a large number of bonds at the lowest possible bid, it could then resell them on the secondary market for a nice profit. Moser realized all he had to do was bid low, but also bid for everything, and he would likely come out ahead. The problem? That was actually against the law. The Treasury had recently set a rule that limited bids to 35% of what was being sold. Now, Moser skirted that in December 1990 when he first submitted a maximum bid of 35% on behalf of Salomon in an almost $9 billion auction of 4-year notes. He then submitted another bid for $1 billion using the name of a customer without authorization. The two bids together, they let Salomon grab 46% of that issue. Moser pulled a similar stunt in February 1991 that allowed him to take 57% of an auction then. This played out a few more times, rinse and repeat. But of course, victories like this, they don't go unnoticed. His competitors, they began grumbling about unusual sources of demand. And the Treasury, it fired off a letter to Salomon asking what the heck was going on. But instead of heeding the warning, Moser, well, he got even bolder. It all came to a head on this day, May 22nd, 1991, when Salomon effectively tried to buy 100% of the 2-year notes being auctioned off that day. Now, the aggressive move pushed yields up 2 basis points over the when-issued price, a near unprecedented move that does not go unnoticed. The Federal Reserve, the SEC, and others started investigations, and in August, the government decided to suspend Solomon from further auctions. The CEO and the president were ousted, and Moser ended up sentenced to 4 months in jail. Solomon shareholder Warren Buffett, he actually intervened, becoming interim chairman and helped to clean a house. But by then, the firm, well, it was already on its way down. It eventually withered on its own, primarily failed by algorithmic trading and other things that made its trading desk irrelevant. And Solomon today, eventually it was taken over by Travelers, which was folded into Smith Barney. And, well, today, it's kind of a footnote in history, but it is one that has sort of had ramifications for where we are today, where primary dealers have to report their largest positions to the central bank. And Moser's scheme also helped to hasten the big move towards greater price transparency and electronic trading that is now a hallmark of the Treasury market. Scarlett.
All right, great look back in history. Coming up, we've got retailers in focus. Deckers and Ross Stores reported at the top of this hour. Jharonne Martis, Director of Consumer Research at LSEG, will be joining us next. This is The Close on Bloomberg. All right, we're rounding out a week full of retail reports with Deckers and Ross Stores reporting at the top of this hour. Both are sharply lower following their latest results. Joining us now to discuss is Jharonne Martis, Director of Consumer Research at LSEG. So, Jharonne, what's notable about both of these companies, despite first quarter beats, they both withdrew their guidance, their outlook for the full year. What does it say when companies are withdrawing their guidance and the stock still plunges in a time when pretty much everyone can agree they have no visibility?
Yes, they're not the only retailer. In fact, about 83% of retailers right now that have provided guidance are warning about the tariff and have not been giving us guidance. Those that have given us mostly negative guidance. And this is because of the uncertainty about the tariffs. It's a very interesting time for retailers right now because their biggest task right now is to try to determine what the demand is going to be. And they have to nail that down over the next couple of weeks because this is it couldn't have come at a crazier time. They have to nail the orders for the holiday season, the critical holiday season over the next couple of weeks. So that's going to be their biggest challenge to try to determine if those high prices of the tariffs are how they're going to affect demand. And that's why we're seeing that many retailers are withholding their guidance this quarter.
And what's notable, too, is that a lot of them are reporting beats for the quarter that ended. And in some cases, we can chalk it up to pull forward demand before the tariffs really took effect. Is there any way to break down how much of that first quarter beat was from pull forward demand? And I ask because that'll help everyone figure out how much sales will grow in the coming months.
It's a combination. It's not necessarily the pull. That did play a factor, but also the later Easter. Because of the Easter, we usually traditionally see that a lot of customers are willing and able to pay full price for a lot of items, and that definitely affected this earnings season. For the quarter right now, the first quarter, LSEG is looking at about 8% growth in earnings, but that's expected to drop to a negative 0.9% for the second quarter, the first negative showing since the pandemic. So this underlines the weakness and how pessimistic not only the retailers are that they're giving us negative guidance, but even the analysts who have been lowering their earnings estimates for these companies.
I'm curious then about the balance, though, between sales and profitability. But because back to the point about the inventory, too, I mean, we heard from, I think it was VF Corp, actually said that. They said, look, our sales were great in the quarter, but, you know, they got really hit on margins, primarily because they said they were trying to import as much as they could while that window was still open. Are you seeing a lot of retailers do that, or is this just something that's kind of very specific to a couple of companies here and there?
So it's very specific to a couple of companies. There are companies that are going to be faring this way better than others. Walmart, Costco, TJX, the best-in-class companies are the ones who are going to determine the price going forward and are going to be able to steal a lot of that market share from a lot of the other names. However, this is not their first rodeo. A lot of retailers already went through a lot of the tariffs and price hikes. The only difference now is that they actually have lower transportation costs compared to COVID. So that actually is giving them some wiggle room there for margins.
Yeah, I was looking at those shipping rates. I was actually surprised how low they were, given all the talk we've had over the last few months.
The containers were about $20K per small container, which is ridiculous. Yes, so they have that going. for them.
I want to ask you specifically, though, about Deckers, which just reported. The shares are down, and I am curious as to how much brand power they have, because they have very unique brands that I would think would maybe have a little bit more staying power, a little bit more visibility, and maybe a little bit more of a price premium, if you will?
Absolutely.
Yeah.
They had huge lines over the first quarter of people trying to line up for the latest Hokas and Uggs, who make about the biggest portion of their sales, about 1/3. And even when you compare Deckers to the other shoemakers, to other shoe retailers, they're actually the best performing ones. In fact, even our analysts are optimistic on the future performance of Deckers going forward because they're so bullish on these brand names. So Deckers is one of the best in class compared to a lot of its peers. Yes.
All right. So overall, with this retail earnings season, I guess we're kind of through it now. It was pretty much what you expected, more or less?
No, we still have a couple more names to report. In fact, according to our StarMine data, there are 3 names that are likely to beat earnings estimate and post a positive surprise. Deckers was one of them. Dave & Buster's, consumers still are gravitating towards experiences over things. And then Five Below, because of their Easter merchandise that resonated well.
I like Five Below. They have great selection of Haribo gummy bears. Jharonne Martis, we got to leave it there. Director of Consumer Research over at LSEG. A closer look at the retail space. We should point out both Deckers and Ross Stores moving lower. When we come back, a conversation about emerging markets. U.S. exceptionalism has been in question for the last few months as investors look to diversify their portfolios outside of the U.S. This comes amid tariff tensions and, of course, concern over the country's growing deficit. In response, emerging market stocks have outperformed and are currently trading at their highest level since October. Amy Oldenburg joins us right now. She's the head of emerging markets equity at Morgan Stanley Investment Management, and she joins us here in Studio 2. The outperformance has been stunning. I guess the question everybody wants to know, at least for the broad EM space right now, is that going to sustain itself for longer?
EM has been out of favor for the last decade. It really has been all about the U.S. story. But while that has been happening, and there's been many transformations taking place in the EM world, if we look at places like the Middle East, we've seen a lot of headlines with the president being there last week. There's just absolute transformation happening in places like Saudi Arabia, UAE leading on some of the AI initiatives. And these are very significant populations. I think in the U.S. always looked at immigration as a superpower in the past. The Middle East has taken a page out of that playbook and is really showing that population and that growth can really take shape. They have golden visas and looking to really double that population from 500 million to close to 1 billion in the next few decades.
What type of access, though, do rank and file investors have? Because when we talk about the EM space, I mean, you have relatively developed markets in developing markets like in Asia and in Latin America. What about the Middle East? I mean, how easy is it for me to access that market?
So as institutional investors, we offer different vehicles for retail investors to access these markets, and we've been doing that for a very long time. We've been managing funds. We have boots on the ground since 2008 and even prior to that. So there is opportunities. I would say active management, again, is really critical in order to access these. If we look at places like Saudi Arabia, where the opportunity is infrastructure development, healthcare, as some of the themes that we really like there, those are in the small and mid caps, and you want to be able to overweight those in your portfolios.
There's also a different way of playing this investment in the region, and that is through U.S. companies as well, as we saw all the deals that were announced during President Trump's trip. Who is winning the race to help the Gulf region build out its AI capabilities? Is it China or is it U.S.? I mean, do you want to be investing in Chinese companies or U.S. companies?
Good question. I think it's a little bit of both, and that's one thing we've seen that Middle East play so well. Really that delegation between kind of the East and West happening there. I'm heading to Asia this week, and we even see Hong Kong Exchange having a conference with Tadawul, so that's the Saudi Stock Exchange. They'll be in Hong Kong next week. So you've seen some of these connections go in both directions, and I think they play a nice place there. I think even from a global business perspective, if you work in the Middle East, you're able to connect with both Asia, Europe, and the U.S. in the best way possible. So the location is really, in some ways, there's been negatives around that location, but there's a lot of positives around that location if you're based there for business.
It's a very effective bridge in many ways.
Yes.
I didn't hear you say that much about energy or oil. Is that an overexposed area where people don't really need to gain exposure because they already have it in one form or another?
There's been so much work being put into diversifying away from oil. If it's tourism, if it's AI, if it's other innovation themes, those are all playing out across Saudi Arabia and UAE.
It's the backbone of the economy.
It is, and that's there, and that's helping them with that capital to take shape. But there's another step of that happening now, which is looking for further foreign investment. So they've been able to really put the capital to work and get that flywheel started. Now it's time for foreign investors to come in, and we've seen that even through conferences like FII, where they've said more of that capital is going internal and they're looking for foreign investors to come. And we're seeing that with U.S. companies show up also now.
And you're also seeing that money flow out of some of these nations as they're looking to invest in things that help them diversify as well. What does that sort of yin-yang look like?
The yin-yang is something that I think they spend a lot of time on. They're very focused on strategic partnerships. I think that's a conversation that you constantly hear when you're in the region, and you're always running into people from companies all over the world. And I think that will continue there.
What's the number one question you get from clients when you're talking about investing in this region?
I think one of the things is what has changed, and probably the oil price. I think the other thing we need to be careful of is valuations and also pegged to the U.S. dollar. So U.S. dollar has been weakening. It is pegged there. So that is one of the headwinds that we see that we have to be careful. But last year, many people weren't going into the region because valuations were so high. So if we see a little bit of pullback, this is an opportunity to start positioning your chips in a place for that long-term rally to continue.
And with regards to just stability, market stability, geopolitical stability, that always has to be factored in when you're dealing in emerging markets. What does that look like in Middle East relative to what we saw in Southeast Asia or in Latin America during past EM cycles?
This is something that we just always have in the back of our minds. I mean, even with a place like India, where we see investors have been there for quite a while. We've seen some of those India-Pakistan headlines. We see this geopolitical issue, even in the Middle East, take shape. It's just something that we have to navigate around. As active investors, we're able to do that and move positions accordingly. It's something we just have to keep in mind. And it doesn't matter if it's North Asia, South Asia, or the Middle East, even Latin America. We can give you many different examples of that. And it's just part of the investment game.
All right, Amy Oldenburg, thank you so much.
Thanks
Amy
so
is
much.
head of emerging markets equity at Morgan Stanley Investment Management. Let's take a look at how markets closed on the day, because even though the bond market managed to recover from yesterday's sell-off, we saw equities not able to do it, not able to hang on, right? The S&P 500 did gain earlier, and it ended up in the final minutes giving up that advance.
Yeah, no real news on that. And we should point out, I feel like everyone's gone home. Congress has already gone home.
Yeah, well,
they
they're
patted
often
themselves
home,
on the back and all that. And a lot of investors, of course, maybe getting ahead of what should be a 3-day weekend, maybe a 4-day weekend for some folks.
Absolutely. Mag 7 did hold up a little bit better, up 0.8%. And Bitcoin, the bright star of the day, reaching a record $111,000. This is the close on Bloomberg. President Trump's signature tax bill heading to the Senate now. More hurdles, of course, are on deck as Republican senators are already pressing for extensive change. Joining us now to discuss is Joe Mathieu, co-host of Bloomberg's Balance of Power. Joe, it'll have to wait a bit because they're not going to get to work right away. This is Washington, after all. Yeah. But what are we looking at in terms of what's most likely to change here?
Well, this is the big question right now, of course. They're spending a lot of time popping corks today in Washington, at least on the House side and at the White House. But the real hard part, you could argue, begins now. We're hearing a lot of different flavors here, and they've laid out a timeline. According to the Speaker of the House, by the 4th of July, this goes to the president's desk. That would be remarkable. It's aggressive, but it's also, according to most of the folks we're talking with, pretty realistic. The question is, what changes? Do they deal with the SALT cap as the House hammered out the cuts to Medicare? We're hearing a couple of different things about this, beginning with John Thune, the majority leader in the Senate, who describes this Medicaid debate as one that is a still very active discussion, does not want to reform beneficiaries, he says. So you could see changes in those numbers, as well as the whole makeup of the bill. Ron Johnson, one of the fiscal hawks in the Senate, says break it up now. Let's focus on the things that we agree on. and then go back to the drawing board. I'm pretty sure President Trump doesn't want to see that happen.
What's the timeline looking like, Joe? Because I for some reason, I thought that this was like on a fast track. And then I believe it was your executive producer told me apparently they've all gone home.
Well, that tends to happen around here, and that was the deadline to get this done, right? Nobody wants to miss the Memorial Day break. Now they can all go home and get yelled at in town hall meetings and in Memorial Day parades. The 4th of July is what we're targeting. The speaker says there's going to be a signing ceremony that will coincide with the holiday, the president's desk. But look, there's a lot of stuff to hash out here, and if you start making changes to things like Medicaid and SALT, it's got to go back to the House to have this whole restive caucus weigh in on this again, which is why I mentioned the hard part could still be ahead. It wasn't easy getting here. And when it comes back with changes, you could see a revolt in the Freedom Caucus, among the SALT Caucus, the New York delegation, and many others who Ron Johnson, or I should say Speaker Johnson, needs to corral.
Yeah, all right. Joe Mathieu, you can catch him at the top of the hour. He's going to have a fuller breakdown of everything going on with this bill on balance of power. We should point out headlines crossing the wire right now, also involving Washington and the President of the United States, with the Supreme Court saying that it is backing Trump's ouster of agency leaders for now. This specifically refers to the NLRB and the MSPB members here. We'll try to get you some more details on that. But we do want to stay in Washington because another piece of legislation also did advance, and that was one involving stablecoin. This, of course, comes as Bitcoin hits $111,000, trading at a record high today, fueling investors' hopes here of more regulatory clarity for the crypto industry under the Trump administration as we move forward here to whatever the next steps are. Joining us right now is David Portilla, partner at Davis, Polk and Wardwell, who helps to represent folks on these issues. All right, let's start off with the stablecoin legislation. So it got past this procedural hurdle in the Senate. I'm not sure where it's going to go next here, but it does appear like it's on a path right now to actually becoming reality. Is that your view?
Yeah, I completely agree. I think it has a lot of momentum, and I think you saw in the latest vote, 69 votes. I think that's about 17 Democrats. So I think that shows pretty strong bipartisan consensus. And I think you see on the industry side, the various stakeholders coming together. There's still some issues that need to be worked out, but I think it's on the path to advance.
If it makes it through, at least based on the way it's written now, what is the net effect on the industry?
I think it's positive. I think the biggest takeaway of this bill becoming law is that you'll see greater institutional adoption of the stablecoin product because it'll be federally regulated. And I think greater institutional adoption means there's more market demand, and that means there's more room for innovation. So I think it's net positive.
What can digital coin issuers start to do or start to think about if this passes? What can financial services companies that want to offer products related to these coins start to do?
Look, I think everyone will start to think about how they can innovate. One of the promises that stablecoins hold is what people call the programmability of money. So that means allowing payments to be automated. And the real promise of this bill is to unlock innovation, because once you have a product that's federally regulated, all types of innovators can think of how they can layer onto that product to allow consumers to access money more quickly, to make payments more quickly, to send money around the world more quickly.
Once this passes, where does this put U.S. legislation and regulation on stablecoins, digital currencies versus other countries?
We'll be catching up to some and leading others. Look, I think the U.S. fell behind on crypto legislation and crypto regulation during the Biden administration. During the Biden administration, we really had a flashing red light to not do much, and that will change. We'll now have a green light to innovate, to develop products.
So as this green light comes, and we should point out a key feature of this legislation is the idea that it's giving the non-banks sort of a real bite at the apple in a way that they wouldn't have had. There still has to be a regulatory framework around that. I would think if you are bringing non-banks into that, how long is that going to take to roll out? Because this isn't going to be like they pass this bill and all of a sudden the light gets switched on, or is it?
No, that's exactly right. Look, I think the bill will empower the regulators to create a regulatory framework. I think crypto is a priority for this administration. I think you'll see the regulators work quickly to put that regulatory framework in place. And so it's always hard to predict, but I think you can see something within a year.
I do have to ask you, there are some folks in the crypto space, crypto faithful, and even a lot of Trump supporters who have raised some concerns about Trump's personal involvement, or at least his business's personal involvement in this space, and how that might actually be crowding out other players who are either in here or want to enter. I mean, how is that going to be addressed? Because that's going to be delicate, as I'm sure you know, given Trump.
I think that's one of the issues that they're still negotiating down to the wire, whether the bill addresses that specifically or not. And so I think we'll have to see if they come up with a specific language on that issue.
We also have the CFTC now down to 2 of 5 commissioners starting in June. Where does that leave our regulators in terms of their staffing, their capability, their resources to oversee this legislation that will be passed and to oversee the growth of this industry?
Yeah, look, regulatory capacity is always an issue. The good news for the stablecoin legislation is the CFTC is not involved. So we have the 3 federal banking regulators and state regulators that'll be charged with coming up with a regulatory framework. And I think they have the people and power to do it.
One final question, and this really has to do on the protections for consumers. I mean, we've seen so many rug pulls in the crypto space, including with stable coins here. If we do get to a point where whatever the parity gets broken, what type of provisions are in this bill, if any? I haven't read it. What type of provisions in this bill, if any, to protect folks against the potential of insolvency?
Yeah, there are provisions in the bill to protect against that. One, in terms of making the reserves backing the stablecoin safe and limited to a small band of assets like treasury securities and deposits at banks. And 2, there's provisions that what we call preference for stablecoin holders. So if a stablecoin issuer were to go into insolvency, the holders of the stablecoin have priority in recovering before other creditors. And these were some of the provisions that were being negotiated down to the wire to make sure that it has the right balance between unlocking innovation and protecting consumers.
All right, David, great stuff here. We're going to leave it there. David Portilla, he's a partner over at Davis, Polk and Wardwell. A closer look at that stablecoin legislation, Scarlett, where it looks like it might be on a path to being passed.
And people talk about it being bipartisan, too, as well, which is kind of unheard of in this day and age. All right, let's talk about something that is also a big deal in Washington and increasingly across the Northeast. The White House stepping up its fight against Harvard University, now banning the school from enrolling international students, saying, quote, leadership has created an unsafe campus environment. Harvard's response is to call the government's action unlawful. Bloomberg's higher education reporter Janet Lorin joins us now. So, Janet, this is the most read story on the Bloomberg terminal over the past 8 hours, over the past 1 hour. How does the government ban Harvard from enrolling international students? Through what mechanism?
Well, through the Department of Homeland Security, universities like Harvard have to be certified. And that is what they are revoking, is a certification for them to enroll international students. And that's controlled by the Department of Homeland Security. And if you go back to the history of it, it actually started after September 11th to get a better handle on students, foreign students in the U.S.
And let's be clear, this is happening immediately with immediate effect because you're talking about students who are graduating right now. The students for the incoming year just got their answers and had to tell other schools they weren't attending and committed by paying a deposit.
Yes, and they're all trying to figure out what is happening right now because it's not only for future students, but it's for enrolled students as well.
Why just Harvard?
Well, as you've been reading about over the last couple of months, they are in a huge escalating crisis with the administration. Mm-hmm. The administration went after Harvard because it's the richest university. It's quite symbolic, $53 billion, and they say they've been a bad actor on a number of fronts, especially anti-Semitism. But they haven't done enough to curb it on their campus.
So there are at least 17 provisions in the law that basically would say that would end up being discriminatory. And I am curious as to when you make something so targeted like this against one university, but not them all. Like if this was a blanket thing, not that would have been any better, but at least it would have been something that would have been a little bit more defensible. Is there going to be any sort of legal avenue for Harvard to push back on this?
Well, they've already sued over one, they already sued before. I would assume that there would be a lawsuit over this, but the Homeland Security Secretary, Kristi Noem, said, this should be a warning to other universities. So we may see more of this coming. It's unclear.
How much do they rely on international students? Do these schools rely on international students?
Well, it's going to depend on the school. Harvard has roughly 27% international students. Now, at Harvard, undergraduates, if you're very low income, Harvard will pay for them. But like many students, wealthy international students come and they bolster the finances of a lot of American universities. There's over 1 million international students. Now, when you look at graduate students, that may be another story because they're top students in the world. They're in research labs. They're the people who are getting affected with all these research grants being frozen. And it depends on the school. If you're a small college who has declining enrollment and you're using international students to bolster your finances, they would be affected. So it's, we're in such unprecedented times.
Yeah.
It's really hard to know what is next. And this is something that they threatened in April.
And of course, international students often pay full tuition as opposed to domestic students who do rely on financial aid. So they've become kind of a source of revenue for a lot of these schools.
Absolutely.
Especially state schools as well, which saw their budgets cut during the great financial crisis and never really recovered as a result. What does this mean for the students who might be lured or have carrots dangled in front of them by other schools outside of the U.S.? Because this gets to the whole idea of a talent pipeline into the U.S.
Well, I mean, if you're a student right now who's committed to going to Harvard for next year, you're probably thinking, do I take a gap year? You remember during COVID, a lot of students took gap years. So we're in times where it's just unclear what is going to happen next.
So the White House has taken aim at Columbia, basically made it submit to all its demands. It's now clearly targeting Harvard. There are some schools that has not touched at all. Dartmouth, for instance. What's the calculus here, as far as you can tell?
Dartmouth, Vanderbilt, University of Chicago, they've just handled things differently. And it's not just the anti-Semitism, it's also the issues of DEI. It's a whole host of issues that the Trump administration would like to see rolled back.
All right, Janet, Lorin helps cover higher education for us. Of course, the breaking news just a couple hours ago, the U.S. banning Harvard University from enrolling foreign students. Of course, potential ramifications here for those folks looking to start school in the fall and for those already enrolled in these programs. Stick with us. We're going to set you up for some of the market-moving events over the next 24 hours when we come back after the break. This is Bloomberg.
Earnings season is here.
Earnings, the hot topic of conversation.
It's going to be a lot of fireworks.
Pretty astonishing moment in time in the earnings context.
Bloomberg is first to break the numbers.
Goldman Sachs, JP Morgan, Morgan Stanley.
Booking, Airbnb.
Meta, Microsoft, Qualcomm.
There's a lot to talk about here.
With the smartest insights.
We're not seeing dramatic weakness.
It has been an incredible period of time from a trading perspective.
We feel really good about the market share trajectory.
Continuing coverage on Bloomberg. Context changes everything.
All right, we had a somewhat interesting day on Wall Street today. Things could be a little quieter tomorrow, Scarlett, given people trying to front run the holiday, but a few things to keep an eye on. And you kind of know we're at the tail end of the earnings season because we start off with big earnings in the morning out of Booz Allen Hamilton.
Well, this is a government contractor, and the stock is unchanged pretty much for the year because Doge has really taken a bite out of all these government contractors.
Yeah, you might get some insights into that. And I guess whatever the status is of those federal budget cuts, we do get economic data as well on the housing front.
Yeah, new home sales seen declining. Also, this comes after existing home sales unexpectedly dropped.
And Fed speak, if you're into that thing, Jeff Schmidt, Kansas City Fed President, Alberto Muslim, and Lisa Cook going to be speaking about the economy, I assume.
Yeah, and Treasury Secretary Scott Bessent will also be speaking right here on Bloomberg at 11:30 a.m. Be sure to tune in then. And the bond market closes early tomorrow, so we'll be really quiet.
The bond market closes early tomorrow. It'll be interesting to see what Bessent has to say. Of course, he has been speaking a lot, really trying to take the message to Wall Street about the policies coming out of Washington and how, in his view, they're going to be favorable to everyone. All right, that does it for us here on The Close. Balance of Power coming up next at the top of the hour, right here on Bloomberg.